You asked, so I'm going to answer, and that is to talk about risk management, advanced risk management. I'm going to talk about risk management in a level of detail that and experience that I haven't really seen many other people in the space talking about. You're going to get some ideas, some concepts for how to manage risk, and I'm going to clear up many misconceptions about what risk management is and it isn't. So as always, I'm making this video because you asked. I'm responding to a specific comment. I shared that my crypto bots were up over 100% on the month to date in April, over $20,000 in profit. That account started at $18,000 this month. And I got a question about equity, allocation margin, win rate, etc. And yeah, I'm going to get into it for you. As always, people are going to say or think like, I don't look like a wealthy trader, but y'all just don't know what real wealth is. I mean, real wealth is in the body, and it's in the health, and it's where I live. It's true my car's a beater, but my dog costs more than the car. Come here. So I understand the value. I understand the value of nice things. There's just some things that I don't think are really worth money. Anyways, also, you're in the right place because this video is going to get like 100 views, but it's going to share some really advanced stuff that's really going to be really valuable. Where have I learned this? Part of it is through, just picking up clues. Like, I haven't had a hands-on mentor who's really an expert, but a lot of us through market wizards. I would say William Eckhart has been a major influence. Just his short chapter in there in Market Wizards. He was Richard Dennis's trading partner, the Turtle Trader mentors. And I made a lot of learnings and money from working with my dev and talking things through. So the first thing that I want to say, people always want to ask about win rate and risk management. Win rate and risk reward have almost nothing to do with risk management, so long your expectancy is positive. So it's like, what's your win rate? How do you manage it just doesn't matter because there's different systems. There's a system with a 95% win rate that's unprofitable because it blows up sometimes. There's a system with a 5% win rate that's wildly profitable because those wins are so big and the losses are so small. There's many other variations in between. You can have a low win rate system that's profitable or a high win rate system that's profitable. But you need to know that it's profitable. In order to do that, you need robust backtested data, which we're going to get into in more detail. And with that robust backtested data, you can then have a win rate and have a risk reward. And as long as it's above 1, you know that you can potentially run the system. Obviously, the higher expectancy, the better. There's a third component as well, which is frequency. If you have a very small edge but high frequency, it could be worth it to pursue it. But if you have a negative expectancy, there's nothing you can do about risk management, but that won't lead to losing money. But there's things you can do to prevent from blowing up. The next common question is, how much leverage are you using? And the answer is that it doesn't matter at all. That's such a noob question when people are like, what's your leverage? Well, the reason it doesn't matter is because you could take a very small position with very high leverage, a very large position with very small leverage. So you understand why what's your leverage? Like, I don't know. Actually, the answer is I don't know. But I think mostly for the bots, it's like 75 or 100. But there's tiny positions. It's trading hundreds of tickers, and the positions are very small. And almost all the margin is open. It uses hardly any of the margin. So a better question is, what percentage do you risk per trade? And this is what I was taught getting into it by guys. Oh, you don't risk more than 1% or 2%. Well, I've learned that this is also sort of beginner. How much are you risking per trade? And the answer I will give you again for my bots is I don't know. I don't know. It's trading 12 systems. There's different risk on each system. And it's trading high frequency. the risk is relatively small. But what I will say is, now we get into what's correct. The place you want to start from is every computer backtest has a max historical drawdown. And you can choose what that is in your live testing. Does that make sense? Now, the greater the period, the more likely that it's going to be a long time till you have a bigger drawdown. But you always assume that there will be a bigger drawdown in the future. One, because it's just more time. Like the future is a sample that you haven't discovered yet, which is going to have extreme data in it eventually. And also, we generally expect that the future won't be as good as the past for trading, for our results. But for the bots, it has a 7-year back test, and I set the max historical drawdown in April to be about 55%. So again, I'm willing to risk more than, I wouldn't say I'm willing to risk more, I basically am, but if I keep trading, I'll have a greater than 55% drawdown at some point, which is, it's a lot of risk, but it's generally necessary to risk a lot to make 100% in a month. Equity allocation, I'm going to come back to that. In order, like, most people don't know the max historical drawdown because most people don't have backtests, and at that point you shouldn't trade. You're not sophisticated enough, you're competing against people like me and my team, and way smarter, way more competitive people on Wall Street hedge funds. If you cannot take the time to backtest your system to prove it has an edge, you're just gambling and you're lazy. You're more likely misled though, because you see people on social media just like placing trades and staring at the charts. That's not what hedge funds and prop firms are doing. They're running algorithmic trading. Code is their IP. They have quants that are programming. They don't have guys who are like watching the 1-minute chart. That's absurd to think that. So you can just tell who doesn't know how to trade by watching them put on trades. Anyways, you need to know that max historical drawdown because it's possible that even risking 1% blows up the account if in the backtest there was like 150 trade losing streak, which is possible if you have high frequency and high correlation in your trades. It's possible if you like trade hundreds of tickers and you put on 100 trades at the same time and risk 1% on all of them and you lose all of them, you blow up, right? So don't risk more than 1 to 2% per trade. That's actually beginner advice as well. You need to know max historical drawdown. So I'm going to talk some other forms of risk management. One is this an accurate max historical drawdown? Is this an accurate back test? Is the expectancy data accurate? How do you know your data is accurate? There's multiple ways. One way is I always like to start with a fundamental idea. That just makes it more likely that it's not just data mashing, number mashing, data mining, which is more likely to be noise. Some other things you can do is what's called in-sample testing. You take your 7-year back test, you run your strategies on 3 years, and then the next 4 years are just live testing, and you make sure that it works. That's one way. There's also robustness concepts. It should work on multiple assets. Test your strategy on a sample of 30 assets, not just one. Test it on a sample of 140 assets, not just 30. Make sure it works on all these parameters. Oh, you can't do that? It's too tedious, it's too hard. You shouldn't be trading. This is a very hard game. You don't have to do it all yourself. You can join our team, or you can start your own team, or join another team of people who are doing this sort of work, but you need to be able to do this. Robustness testing, another way is testing on different assets. One asset is testing on different time frames, making sure that your testing period includes historical crashes and so on. There's different ways to do robustness. Now, another form of risk management is system cutoff, having a cutoff point. A couple basic examples of this are if the system makes a new max historical drawdown, we shut it off. I've used that before. Another one is if the system goes under the 200 moving average, you chart your own system. If it goes under its own 200 moving average, you shut it off because it's become unprofitable. So that's another shut off. We're using more sophisticated ones. One of the ones that we like is a combination of short-term and long-term moving average if it's under both. You can also do, one thing we found works decently is you take the logarithmic return of the last 25 trades and if it's negative, you shut it off, and you just pay attention to the rolling average of the last 25 trades. That's an idea for mean reversion. Another one, this isn't so much about risk management, but to improve the returns relative to max historical drawdown, is to have uncorrelated or inversely correlated trades. So on our bots, we have like 12 different strategies. Some of them are uncorrelated or inversely correlated. And that's a lot better than having one amazing strategy, is a dozen basic systems that are different. Now we get to other forms of risk management. One is equity allocation. That's a good question. So, and just to answer, at the start of the month, the 18 grand I had in there was less than 50%. It was sort of a small allocation of what I have. The majority was in cash savings, but I've now deposited significantly more. It's now like 90% is in this, just because it's working. I have other systems, and as those systems fire up, I will rebalance, but right now it's the only thing that's trading, so I just double down on what's working, put a lot of money in that. Shoot, what else? What else can we say? Another form of risk management that is important is just having an income outside of trading. That's one reason that I like to license our system to raise money, but also I have a day job working in adventure tourism. I like to do that. That's another form of risk management. It helps you go through the big drawdowns, which I know are coming. And yeah, if you have more questions, you can ask. There should be a link down below for more information on the bots, where you can access the dashboard for free and play around with some of the data if you want. If you don't see it in the description, just comment down below and I'll send you the link. Okay, appreciate y'all. Much love. Talk to y'all soon. Peace.